The most aggressive institutional sell-off in 13 years is sweeping across global markets, and NVIDIA is right at the center of it, with its stock violently shaken by macro volatility, yet behind soaring oil prices and the shadow of war. Jensen Huang just revealed a $1 trillion lifetime order forecast, pushing demand visibility all the way into 2027. So what is this really? The twilight of a chip empire, or a golden dip created by Wall Street's risk-off panic? With $215.09 billion in annual revenue and an insane 75% gross margin, NVIDIA is making a historic leap from a component supplier to a full-stack system powerhouse. Hey everyone, welcome to Stock Market Breakdown. NVIDIA's recent price action has made a lot of investors uneasy, especially with all the noise around institutional selling. But if you actually understand Goldman Sachs' latest liquidity report, you'll realize this isn't a targeted on NVIDIA, it's a broad, indiscriminate global exit when oil spikes above $110 and geopolitical risks choke off key trade routes. Capital doesn't think it runs for cover. Goldman Sachs data shows that hedge funds dumped global equities in March 2026 at the fastest pace in 13 years. This was a classic extreme risk-off move. High-growth names like NVIDIA and Tesla weren't sold because of weak fundamentals. They were sold because they're highly liquid. Institutions needed to deleverage and raise cash fast, and these stocks became their go-to amidst. This isn't a fundamental breakdown, it's collateral damage. You have to separate fundamental deterioration from liquidity demand. When hedge funds face redemptions or margin calls, they sell their winners first. NVIDIA performed exceptionally well last year, so naturally it became the top-selling target. This kind of selling has nothing to do with earnings, it's purely technical. The real driver behind the sell-off is geopolitical fear. As conflicts escalate and key straits get shut down, oil has surged past $110 per barrel. That uncertainty is pushing capital into defensive names like Walmart and Costco, while pulling money out of high-beta sectors like semiconductors. The market is pricing in a stagflation scenario, where high-growth stocks typically get it first through valuation compression. This is classic risk-off behavior. When war headlines hit and oil spikes, Wall Street instinctively buys essentials and chips. But here's what people are missing: the AI infrastructure boom runs on its own cycle. In fact, higher energy costs could accelerate AI adoption as companies look to optimize efficiency. So this macro noise is short-term, as masking one of the most powerful infrastructure build-outs in history. Despite the volatility, NVIDIA's fundamentals are incredibly strong. In fiscal 2026, the company delivered $215.09 billion in revenue, up 65% year-over-year. Even more impressive, gross margins held steady at around 75%, an unheard-of level for a hardware company. Data center revenue alone hit $62.03 billion for the quarter, up 75% year-over-year, reinforcing NVIDIA's absolute dominance in AI compute. A 75% gross margin in hardware is almost absurd. That's software-level profitability applied to servers. And the fact that margins are holding while revenue is exploding tells you one thing: NVIDIA has total pricing power in the supply chain. CEO Jensen Huang revealed the lifetime demand for Blackwell and Vera Rubin platforms is projected to reach a staggering $1 trillion, double last year's estimate. Current supply commitments already stretch deep into 2027. That means even if new orders stop today, NVIDIA's production lines will still be running at full capacity for over a year. This level of demand visibility is virtually unprecedented in tech history. $1 trillion in orders, that's years of locked-in revenue. The market keeps worrying about AI demand peaking, but the data shows the opposite. Cloud giants aren't slowing down, they're accelerating. NVIDIA isn't chasing customers anymore, it's allocating compute. NVIDIA's latest Vera Rubin platform is now in production, and it's no longer just about chips. It integrates CPUs, networking, and storage into a complete AI system. This full-stack approach significantly increases customer lock-in and per-deployment value. NVIDIA is no longer just the hardware vendor, is becoming the architect of AI infrastructure, building an ecosystem that competitors will struggle to break into. This is NVIDIA's most strategic move. If you're just buying PUS, you can switch vendors, but if you're buying an entire system, you're locked into the ecosystem. That's how they double deal sizes and build a moat that's incredibly hard to cross. Even during the peak of the sell-off, Wall Street analysts maintained a strong buy consensus, with the stock trading around $184. Firms like Goldman Sachs are still assigning price targets as high as $380, implying over 100% upside. Analysts believe the market is underestimating the sustained AI capex from hyperscalers, and that this disconnect is setting up a major valuation re-rating. At $184, people think it's broken, but to analysts, this is a 50% discount. The $380 target isn't randomized based on the trillion-dollar pipeline and 75% margins. Once the forced selling ends and rational pricing returns, the rebound could be extremely sharp. Goldman Sachs data also shows that by the end of March, hedge funds became net buyers of tech stocks for the first time in 4 months. Much of this was driven by short covering, but technically, that's often the first step in a bottoming process. It signals that downside pressure is fading and buying momentum is starting to rebuild. When shorts start covering, that's your early bottom signal. These are the smartest players in the market. They know shorting NVIDIA at $180 carries more risk than reward. Once the selling pressure disappears, it doesn't take much buying to trigger a sharp V-shaped recovery. What we're seeing now looks like base building before the next leg higher. Of course, risks remain. NVIDIA has a high customer concentration, with for hyperscalers driving the majority of revenue. Any slowdown from them could have a significant impact. Additionally, export controls remain a key variable. Still, given its overwhelming fundamentals, NVIDIA remains the dominant force in the AI space. At the end of the day, this pullback is a macro-driven sentiment dip. The trillion-dollar demand pipeline is the backbone, and the 75% margin is the moat. If you believe the AI revolution is still in its early stages, then today's price may be one of the most important entry points in this entire cycle. Do you think NVIDIA can hit $380 by the end of 2026 despite oil volatility? Drop your thoughts in the comments, like and subscribe to Stock Market Breakdown. You'll see you in the next